All right, let's talk about Employers, Inc. That's ticker EIG. Their latest earnings report? Wow, it was a real head scratcher. You've got these wildly different numbers pulling in opposite directions, and the market, well, it definitely noticed. So we're going to break down exactly what went on.
Okay, so check this out. A 14% revenue beat. That's huge. Normally, Wall Street loves to see that. But, and this is a big but, they missed earnings by almost 50%. Ouch. And the stock? It got hammered, dropping nearly 10%. It's this crazy contradiction that's at the heart of the whole story, and we've got to figure it out.
You see, this is the classic tale of two tapes, right? The revenue number is screaming, hey, we're growing, we're signing up new business, it looks fantastic. But the earnings number is whispering, actually no, it's shouting, we're not making any money. It's like having a restaurant that's packed every night but is somehow losing a fortune. So the big question is, where's the disconnect?
So let's look at the hard numbers. Yeah, you see the revenue beat, you see the earnings miss, but the real smoking gun, the number that tells you everything you need to know, is that combined ratio 105.6%. Now for an insurance company, that's the key metric. Anything over 100% is bad news. It literally means for every dollar they're bringing in from premiums, they're paying out $1.05 in claims and expenses. They are losing money on their fundamental business, and that right there is your earnings miss explained in one number.
So naturally, this leads to the million-dollar question, the one everyone on the earnings call was desperate to get an answer to. What on earth caused that underwriting business to blow a hole in the quarter's results?
And the answer, believe it or not, comes down to this one really tricky issue that's just exploding in California. It's something called cumulative trauma claims. Now, these aren't your typical slip-and-fall accidents. Think of them more like wear and tear injuries that develop over a long period. But here's what makes them so gnarly, especially in California. You can file a claim after you've left your job. Lawyers are almost always involved, and now, with remote hearings, these cases are popping up all over the state. It's become a huge headache. So management is watching this trend get worse, and they know they have to do something and do it fast. So they made a big move. They raised what's called their loss pick. Basically, that's just the chunk of money they have to scroll away from every premium to cover future claims. They cranked it up from 66 cents on the dollar to 69 cents. Now that might not sound like a lot, but it has a massive, immediate impact on your profits.
But here's the real kicker. This is where the quarter's profits just vanished. See, insurance companies usually find that they oversaved for claims from years ago, so they get to release that extra cash back and it flows straight to the bottom line. Well, this quarter, Employers had over $50 million of that found money, but instead of booking that as a huge win, they had to take every single penny and use it to patch up the growing hole from these new claims. That one move? Poof! A giant chunk of potential earnings just disappeared.
Okay, so the company's in a tough spot. How are they going to get out of it? Well, management came out with a very clear four-part defensive game plan. First, they're slamming the brakes on growth. Second, they're getting more picky about who they insure. Third, they're moving money around to cover these losses. And fourth, they're trying to keep investors from bailing by sticking with their dividends and buybacks.
And you don't have to take my word for it. The CEO, Kathy Antonello, said it herself. This isn't some accident. It is a conscious, strategic pivot. They are willingly giving up on fast growth right now because, simply put, the risk of taking on bad business just isn't worth it. Profitability over growth. That's the new mantra.
So faced with a panicking market, what's management's big comeback? They point to this one key number. Book value per share is up almost 13% year over year. Their message is basically, hey everyone, calm down. Look past the mess of this one quarter. The underlying fundamental value of our company. It's not just stable, it's growing strong. It's their way of saying the foundation is solid.
Right, but as we all know, in the short term, the market isn't a weighing machine. It's a voting machine. So management is playing the long game. But how did the market vote on this idea of taking pain now for stability later?
Well, the vote came in and it was a landslide in the wrong direction. The verdict was absolutely brutal. The stock just cratered, down almost 10% in a single day. The market basically heard one thing, profitability problem, and hit the sell button. It was a classic case of sell first, ask questions later.
And let's be clear, this wasn't just a few nervous investors selling off. The trading volume absolutely exploded, more than 2.5 times the normal amount. When you see volume like that, it tells you this was a high-conviction move. The big money, the institutional players, they were heading for the exits fast. They decided the uncertainty around this whole California situation was just way too risky. Okay, so that's the story of a very rough quarter. Now let's pivot and look forward. What's our take on what comes next? What do you really need to be watching for?
All right, looking ahead, there are really 4 key things on our radar. First and foremost, there's a big actuarial study coming in Q3. This is huge. It's going to be the official report card on whether they set aside enough money. Second, the big wild card, legislative reform in California. Any kind of reform could be a massive game changer. Third, are they still buying back stock? And finally, we need to see proof that their new strategy is working. Is that combined ratio starting to creep back down?
So, putting it all together, what's our official rating? We're calling it market perform. Look, the bottom line is that this California claims issue is a big dark cloud hanging over the stock. Investors got burned and they're going to be in show me mode. They need hard proof that management has this under control before they'll jump back in. So expect the stock to be pretty choppy until we get the results of that big study in Q3.
Okay, but let's talk about a potential trade here. A more contrarian view, if you will. The thesis is this. The market has punished the stock for this California problem. But maybe, just maybe, it's overdone. Maybe the market is so focused on the one problem that it's completely ignoring the strong balance sheet. And here's the kicker, there's a huge potential catalyst. The California Insurance Commissioner is pushing for legislative reform. If that happens, this whole story could flip on a dime. A bold trade would be to bet that either that fix happens or the Q3 study comes back clean. The risk, of course, is that the problem gets even worse.
So, in the end, the whole story for Employers Inc. really boils down to one question. Is this California claims issue just a small, containable fire that management can put out? Or is it the start of a much bigger wildfire? The next quarter is going to give us a pretty clear answer. And as always, please remember, this is not financial advice.